All right, let's start. All right, everybody, let's start. I want to make sure everybody's the sides in your paper topic. Oh, it says paper one topic, paper two topic this week. So we'll talk. I have one person who's sent me their idea. They give you some ideas. I collect articles. I see them. Bloomberg and The Economist have had some interesting articles. So one great topic is how organizations like we looked at the Highway Institute of Safety, how they're changing how cars are built. You're seeing the same thing on homeowner side. So here's a really interesting article. I think this came from Bloomberg News on new kind of roofs that are helping insurers, homeowners. It's an interesting article. This one's, if you found this one and maybe one other article, could be your paper topic, maybe not just on roofs, but roofs is a pretty major one. Anytime we have health storms, we can just hear the symphony of people building roofs, right? Just people pounding all over the place. It's very, very expensive for homeowners. Somewhat related to that, that could be a topic, is what's going on with Congress and some of the debates about our insurers denying claims. So I'll show you this one. You don't doesn't have to be an article, it can be video.
Could be when he was hearing his insurance company.
There's a hole in the roof. And State Farm comes out and it's in fair condition. We're like, there's a hole in the roof.
The police officer and his wife, Lacey, look, I was an attorney, live with their 5-year-old on a cul-de-sac just outside Tulsa, Oklahoma. That hole in their roof, they say, the result of a vicious hailstorm in 2023. Billy says he spoke to multiple contractors and everyone agreed.
You need a full roof replacement. And for them, it seems like a no-brainer. They say, who's your insurance provider? We say State Farm, and their head would drop.
Despite having a policy that covered accidental damage to the home, State Farm denied their claim, finding the roof was in fair condition. 8 months later, another hailstorm, and the Hirsches say they found even more damage to the roof. This time, State Farm acknowledged it, but called it minor and refused to pay for any replacement.
Did you feel like, well, wait a minute, I paid my premiums on time, why am I not getting my roof fixed?
Absolutely. It makes you feel like the entire system of insurance is rigged.
Afraid of what might happen when the next storm hit, the Hirsches put on a brand new roof.
Every shingle up there is new.
The cost? More than $22,000.
We have to borrow against the equity in our house.
You have to borrow against the equity in your house to get your roof replaced.
Yeah, it forced us to reevaluate our financial planning by decades.
The Hirsches are now suing State Farm, alleging the company devised a fraudulent scheme to deny or underpay valid hail damage claims, saying State Farm knew the scheme would work only if it was kept secret.
We've discovered and reached a conclusion that State Farm has a scheme of deception.
The state's Attorney General Getner Drummond now joining in this legal battle after a state court granted his
So you got a case you can look up. So what I think fascinating about this, because it's not just State Farm, I've seen Allstate on Congress as well. I don't know if there's anything there because these are videos coming out of my stream. This looks like a legitimate, since it's NBC Nightly News. This isn't some TikToker. Is there something going on, and is it different? Has something changed recently? Another article I'm going to show you is that homeowners insurance premiums are up quite significantly. What's going on with this industry? So it's an interesting research topic. You want to be really as unbiased as you can. It's possible State Farm's not doing anything wrong. We saw when we looked at the issue on the what was it? Mold or whatever. No, storm surge. When we looked at storm surge, State Farm was in there. There was obviously some questionable. This is on the adjuster side. So is there something going on with homeowners on the adjuster side? Is the industry really trying? And here's how they play the game according to this part of this video.
Office the power to investigate.
I think that as we go deeper into this lawsuit, we'll discover that State Farm has reaped billions of dollars of profits off of Oklahomans, and that's not going to be tolerated.
No.
There's no problem with them making money, right? So that shouldn't be, he should say, this isn't fair, they're making money. I mean, that's kind of what you're in business to do. So No, his approach there, it's like, he should be saying, it's not fair they're not paying claims they should be paying. He should be saying they're making billions of dollars. That sounds like a lot, but billions of dollars, Oklahoma is a pretty big state.
Assuming law firms tell NBC News there are now more than 600 similar cases against State Farm in Oklahoma. The company, which is the #1 property insurer in the state, declined our request for an interview, but in legal filings has denied any wrongdoing. State Farm telling us it has paid more than $1 billion to Oklahoma customers.
That means nothing, right? Hey, we paid out some money, so obviously, so this is not a well-researched, you want a more actuarially sound discussion here.
For wind and hail damage to their homes and property over the past 2 years.
But Attorney General Drummond is investigating possible racketeering or RICO violations by the company.
You could try that, RICO, if y'all know what RICO is, you could do RICO and State Farm and see what comes up. It'd be interesting to see.
Allegation State Farm calls frivolous.
People think about RICO laws applying to the mob. Is State Farm the mob?
It may very well be. There may be a scheme inside of State Farm's leadership to intentionally defraud Oklahomans. And if that can be proven, that RICO will cross into the criminal world.
So supposedly the argument is State Farm just denies, and hopefully it so irritates the homeowners, they just give up. Here we have a class action though, is kind of this.
Whatever comes next, just say a roof over your head is worth the fight.
I can protect my family and maybe help protect someone else's family.
All right, with that, Laura joins us now live in studio. Laura, there are so many of these cases. You have found some have actually already settled?
Yes, Tom, we have found more than 100 of these cases. Similar types of claims have actually settled, but the Attorney General wants to investigate why and what exactly, if anything, State Farm has admitted about its practices as part of those deals.
All right, we know this.
All right, so there's a potential one. I find it interesting because I'm just seeing them coming up. It's the adjuster side has been most of the issue there. So there's a lady in a Lotus. She had roofing issues, and she was telling me her story of how frustrated she was that she could not get. Part of what the insurance company said, they replace her roof with cheaper material, but it wouldn't match the rest of her house. He's like, no, this is $1 million house. I'm not going to have 2 different colors of tile on my roof. So she fought it. She finally won, but it probably took her 2 or 3 years to get it to all work out. I'm very, very frustrated. I'm hearing more of these stories, but it's very anecdotal. I don't want an anecdotal paper, but if you can research it, I'd be really interested in the results. You might find it interesting. If you have a friend or a family member that's going through this, then the research could be really helpful for them as well. I don't know what happens when you type RICO and State Farm. If anything comes up, Rick Torres. This says 2018. That's Oklahoma. State Farm dodged billions in 2018. Now faces fresh RICO claim against State Farm. So it does come up, but you got to look at the source. A personal injury law firm might not be the most unbiased source for this. So try to find some good discussions. But the homeowner side sets up pretty well. You'll see another article down here talking about why are homeowners insurance claims so high. So, but it is, a lot of them are either roofs or the wind versus flood tend to be the biggest issues on the homeowner side. You don't typically have, if a house catches on fire, that's usually not an issue. Insurance covers that pretty well. Theft. It's usually the roofing side or it's the flood versus the wind that comes up on the homeowner side. So here it is, why are insurance costs, and this is on the homeowner side. Why are insurance costs coming up so much? There's some good data in there. Is that another Bloomberg article? Yeah. I don't know what BB, that looks like Bloomberg. So global warming is an interesting topic. So global warming and all of its issues. So you've got the number of storms, you got the power of the storm, and then you have, does it hit landfall? And global warming can have an impact on those, and you can even question, has global warming shown up in the numbers yet? Or is it the El Nino, La Nina issue? So here's an article, this is, I think, an economist article. It may not be, this might be from Yahoo Finance because it's got the time on it. So interesting article, a lot of here about Melissa. And it looks like Melissa was a really important storm, an unusual one. I think it hit Jamaica. I don't think it hit in the US. I'm not real sure, I can't remember. But interesting article. This is a good, solid article. You could almost do a paper on just on this article. For interesting discussion. You can see about the length of it. Here's another topic is, has anything changed on credit scores? So the articles I gave you was when Texas researched it, which is really, really good. I haven't heard anyone else coming up with it, but here's an article in Florida asking about credit scores and your insurance rates. That could be an interesting update. Is there something you can add to what we talked about in class that would be interesting to you and to me? What I like here is they have, I couldn't get it into the article, but the article actually had this massive thing you could click on to go state by state and look things up. So here they're showing, this is a really good chart here. You can see how cheap USA is versus other insurance companies. The lowest on the low end and the lowest on the upper end. But the range that you see on credit scores, but even at USA, as low as it is, you can see the range on the up end is 3 times almost what the lower end is. But interesting concept, if that's a topic you might find interesting. Good, so you see the size of these articles. That gives you something of substance to really work with. And then catastrophe bonds are interesting. Just a discussion of catastrophe bonds, how they're changing the industry, how they're competing with reinsurance. And then we have here of this, this particular hurricane, this might have been Melissa again. I can't remember. Yeah, Hurricane Melissa. Looks like it triggered the catastrophe bond, which means what? It went over that limit, that deductible. So interesting one. This is Bloomberg, which tends to be better articles anyway. And you can go into Bloomberg, type news, and actually search on cat bonds, and all kinds of articles will come up. They have a really good news search. If you have a Bloomberg account, it's really easy to get one. So there's an interesting, that one's a little short, but it's one where it's interesting. If Jamaica's hurricane did trigger a cat bond, there should be plenty of articles written out there. What does that mean? How much did the bondholders lose? Did it change the interest in these bonds because they've been oversubscribed? So there's a lot there you could do. This article just kind of was interesting to me on the reinsurance side. I'm not sure it would work as a paper. But it's about reinsurers and how they make money. So it's interesting about this couple that started this and ended up making billions from it. Might make you interested in starting your own business. This is real similar to the roof, super roof, is how can you reduce your homeowners by upgrading your house? So real similar to the auto side. How can we make houses safer? So it's better for the insurance company, better for catastrophe bonds, better for reinsurers, better for the insurance company, better for everybody. So this one's a little bit, I mean, again, a lot of it's going to be talking about roofing more than anything. When I was at USAA, there was a guy who wanted us to invest with him. He was using old tires and melting them down and making roofs. He had some money from Allstate. I was supposed to ask USAA to invest with him. He was a strange man. So I was like, I don't think so. He was explaining to me his prison record and why it doesn't count anymore. And I didn't even bring it up. He just starts talking about it. So he was a bizarre guy. He had a balance sheet where the largest thing on the balance sheet was goodwill. And I think, I don't know why an individual starting their own company would have goodwill on their balance sheet, but it was strange. So I was like, yeah, I don't think we'd give this guy any money. I don't know how he's done since. But there is a lot there. That's a really substantial article right there that could lead you to some other things. This article I thought was very interesting from an actuarial standpoint, why car insurance in America is actually too cheap. And essentially what they're saying is most drivers are undercovered, they're not paying enough. I thought that was an interesting article. It's a substantial one, maybe not enough, but it's kind of in the ballpark. Here's an article on homeowners and climate change and the impacts there. I don't know why Italy have residence as a capital S. You can kind of tell the economist articles because they can't spell in Britain. So you have a lot of what looks like misspelled words. So another interesting article with some good charts as well. We really can tell it's economists because they do have really, really good charts. And if any of y'all don't have an economist account, catch me in the FSC. I can use my account. They have another really good search engine. You can just go to an economist and just type homeowners insurance on all kinds. They write really, really good articles. They write a lot of them. I read it every month, every week. So it takes me 3 days to get through it. So it's about 10 hours worth of articles, and I have it on like 1.5, 2 times. So a lot of really good articles, and they do occasionally have an article on the insurance industry. Like, is that how you spell swinging? So the Brits just can't spell. But anyway, so if any of those interest you, I can put these out on Canvas just so if you want to kind of shop through them to see what's out there. I'm kind of jealous of you because every time I see one of these, I was like, yeah, I want to go research these, and I don't have any time until the summer to really get into it. Anybody besides Aaliyah have their topic picked?
I got to write on autonomous vehicles, the pros, cons, and the impact on the insurance industry.
Say it again.
Autonomous vehicles, the pros, and cons, and like the overall impact on the insurance industry.
And that last part, make sure, Tyrone is exactly right. Don't write a paper on autonomous vehicles. This is an insurance class. You can talk about autonomous vehicles, get some background. Which level are they on? Is it the Tesla approach or the whatever approach? You got these different approaches. But you want to get down to what is the impact on the industry? What does this mean for the industry? Topics there are number drive accidents going to come down. Is it reducing frequency? Is it reducing severity? Does it make auto insurance more expensive because there's all this extra stuff in the car that you got to replace? Will people even buy cars in the future? Will everything be rideshare? Those are the kind of things. There's a lot of topics that you'll see, and there's plenty of articles. There's plenty of articles on autonomous vehicles, but there's a lot of articles on autonomous vehicles and the insurance industry as well. So you can find a lot. Anybody else like that topic? Global warming. Okay. This is one I see. Focus on homeowners insurance. There should be a lot out there. Don't forget the NOAA site. When I spoke at UTSA one year, you might not want to do this. It might take a little bit of time, but I took the NOAA's map of hurricanes each year and I put them all on one big PowerPoint. I was just asking the frequency, the size, and landfall. You can just look. It was kind of interesting. The actuaries, a lot smarter than I am, but they hadn't thought of doing that. They were like, wait, what are you showing? They thought it was kind of interesting. Can you just visually see an impact that I had a couple of decades of them out there all on one chart and just looking to see? And it was kind of fascinating. It would take some time, but you just keep clicking on there. Anyone else want to do global warming? Anybody else have a topic yet? Andrew?
Like advancements in automotive safety, how that's affected the insurance industry?
Yeah, that's a really fascinating topic. And if you can find the more recent ones, it doesn't have to be the car itself. You can do roundabouts. There are other things out there. I think the big things now are cars that can see around corners and, using more and more kind of advanced technology to make the car have more than 2 eyes of the driver. Yeah. It's interesting, autonomous vehicles versus, what's the word? before autonomous vehicles, but there's so many more things on the car watching out for you. You know, your side impact kind of things telling you, hey, don't change lanes, or someone over there. So there's a lot of that going on. So the Institute of Highway Safety should be able to show you quite a bit of stuff on that. You should be use their site. Anyone else interested in that topic? That's a pretty fascinating topic, actually. All right. Anybody else have a topic?
To the Jesse Jackson versus insurance company.
Oh, really? Okay.
I think I mean like in specific, like, you know, redlining, economic inequality and Medicare.
I don't know if you're fine enough, but if you can't, you might talk about the political influence on the industry, maybe throw Ralph Nader in there. It's a different angle, but so Jesse Jackson on the homeowner side, Ralph Nader on the auto insurance side. If you can't find a good, I'm not sure you'll be able to find a good article. It's part of it, it's kind of old because he was kind of old, right? A lot of this he did like 20 years ago, so I'm just worried you may not be able to find an article. Ralph Nader, you can definitely find Wikipedia's, but first, see, so you can put out a topic and then go see if you can find the articles, just to make sure there's something there. But yeah, just a lot of times just Google it. Yeah, show me all this homeowner stuff when I was showing me Jesse Jackson.
Might have to go on like Google Scholar. Yeah, because I feel like a lot of these companies are gonna pay to be like the person you see on the.
Yeah. I'm not doing it great, and ChatGPT might help you as well find some stuff. So, Jeff, I just remember the discussions. There were actually meetings set up. This wasn't like some informal stuff. It was actually like a conference that they sat down together and talked. So it's out there, but what they documented from those meetings, I don't know. Yeah, that'd be interesting if you can find stuff. Others, there's a lot of really great topics out there. Warm, all right. Let's see. Brianne. All right, others. All right, so in the class notes, I had a list of some topics you could certainly look at. You might pick 2 or 3 of them. Really, the key is finding 1 or 2 really substantive article to summarize. So make sure you can find the stuff. If you want to sit down with me with the Economist, let's see if I can get into my Economist account real quick, just to show you it really is. And I do highly recommend the Economist to read every week. I would recommend it higher than I would recommend the Wall Street Journal. So homeowners insurance, you can do it. Here's insurance against political risk. Homeowners face a 225 trillion. That's the one I just showed y'all. So you can see Hurricane Harvey has exposed the inadequacy of flood insurance. That's from about 9 years ago. You can do it by date as well, so you don't have such old articles. You don't want to do private credit. And you want to make sure it's homeowners health insurance. Yeah, so Ukraine's housing market is increasingly peculiar. That's probably a little too specific, but plenty of articles, and they're really, really high quality articles between them and Bloomberg and Yahoo. Yahoo Finance has some really, really good articles on homeowners as well. I'm not sure on auto insurance if you would find the same quality. Autonomous vehicles, they will have autonomous Autonomous vehicles are coming, but slowly. Autonomous vehicles just around the corner. The add and insurance. So, how do you find safe driving in terms of a machine can understand? That looks like a really good article right there. Who is doing? You're doing that one, Tyrone. That looks like a really good article right there.
Is it possible to get that from you sometime?
Yeah, email me. I have to copy and paste it in the. I can't send you the link unless you have a Economist account. But yeah, some of the best. Who's self-driving your car? A pedestrian has been killed by a self-driving car. That one's kind of old. And part of it was not to blame the victim, but part of it was he was kind of in a strange place for the car. I actually, there could be 10, who knows, 10, 15 years from now where we actually might have autonomous vehicle highways. So there's no pedestrians, it's completely roped off and it's just cars so that, there aren't bicyclists and pedestrians especially cross country, I can see a time where rather than trying to catch a plane to Dallas, which is, you're going to spend 4 hours getting to the airport and, 40 minutes on the plane. I'd rather just get into a car at 10 o'clock p.m. with a bed and a pillow and my iPad, and my car drives me to Dallas. And I just sleep in the car. And it's not a normal car because you don't need the seats facing forward. That would be kind of nice. It would probably be cheaper than an airplane. It'd probably be a lot more pleasant because I can lay down. If you had special highways just for autonomous vehicles, so it's much, much, much safer. Boy, you could see all kind of benefits. One thing you might think of is when you think autonomous vehicles, and I don't know if this would be here, autonomous vehicles and trucking, which is even more, a lot of more fascinating things going on there. What happens to trucking where you don't have to pay for the driver? And you think about trucking, one of the dangerous things, any of y'all been on Highway 70 in Colorado? It's a horrible highway and you have the snow. You can smell the brakes of those trucks trying to stop on those hills. And you just think, and they have those, those escape things. It's just, I've been there where you just see them coming down the hill. You're like, man, I hope they can stop. What happens to trucking where they have a driver that can drive 7 days by 24? You don't have to pay them. And they can drive 10%, 15% more slowly. So they can cover a lot more area because they're 7 by 24. They have a lot fewer and a lot less dangerous accidents because they're driving more slowly. Think about the impact on insurance and the impact on the trucking industry. It's just like win-win situation. I think this industry has far more incentive to go to autonomous much faster because they have a shortage of drivers and the data is there right now. They have autonomous trucks, but you have to have someone in the truck watching it. But you think about trucking, a lot of it is out on the open highways, which autonomous can do a lot more easily than city driving. So, there's something there. I don't know if they cover insurance here. Doesn't look like it, but, you could probably find some articles there. So I don't know if that Tyrone interests you any there, but I love The Economist. Some guy in my class last semester said there's a socialist rag, but I don't think they're all that socialist, but then they're pretty good articles. All right. So in the class notes, pretty far close up to the top, I gave some topics: cybersecurity, autonomous vehicles, terrorism's kind of getting a little old now, regulation of auto insurance, global warming, gig economy, cat bonds. AI in insurance is interesting, especially with telematics. I think telematics is a really good topic, very interesting topic. And I gave you some sources. So yeah, I mean, there's a lot of really cool topics. I don't do this in my life insurance class because it doesn't lend itself quite as much. Let's see if Bill Gates can do this right. I don't know why it can't show me the page number while I'm scrolling. All right. So what I want to do here is finish up the asbestos. We kind of started it. And then last Monday with the exam review, I decided to kick to something else, give us a little more time. So we saw with asbestos a huge increase in frequency and a strange change in severity because the biggest claims were being challenged, the smallest change were going to class action. So you had this strange phenomenon. And so here's where what we're going to talk a little bit more tonight about tort reform. I can't get that to work, but you won't let me highlight it. But anyway, tort reform, you'll see some tort reform in here. One of the biggest parts of tort reform is the class action, putting a lot of claimants together. So it makes it much more difficult for the insurance company to challenge it. Many of these claims have been diagnosed through mass screening programs. How fraudulent are those? So just to give you some examples, they published a radiologist called the diagnosis of some physicians. It called the diagnosis of some physicians into question. The study by independent radiologists reviewed 500 X-rays that had been previously put in evidence for asbestos lawsuits. The independent radiologist found abnormalities in 4.5% of the films versus the original readings found abnormalities in 96%. Pretty big difference in those two. When your incentive is to find something, guess what? You find something. When your incentive is to look for the truth, you don't find it. And then another evidence of fraud here is people getting diagnosed with these two diseases, which is really extremely rare for someone to have both. That some doctors have diagnosed claimants with asbestosis at the same time that they at one time, and then cysticercosis this at a later time. They had people filing both of these. Why? Because you're getting lawsuits, you're getting insurance trust from both of them, even though they have different causes, and most people don't have both. So Judge Jack, she's the one who really is cleaning up this whole mess, concluded these diagnoses were driven neither by health nor justice. They were manufactured for money. So her decision is likely to lead to higher medical evidentiary standards for silica as well as asbestos claims. Sounds real similar to what we talked about with mold. Is there really something here, or is it being manufactured to milk the insurance industry? The impact of heightened scrutiny in conjunction with the stricter medical criteria adopted by some states in the form of inactive dockets or legislation may lead to fewer mass settlements or pending claimed inventories, and will likely affect whether and how mass screening activities conducted. So if you require to have medical evidence doing a class action, it gets a lot more difficult because now you got to get specific information on each claimant, and it's probably going to reduce the number of claims. There's some charts in here that you might find interesting. There's some charts looking at the number of deaths or the number of claims and the average, and you can really see some of this is being manufactured by the Trial Lawyer Association. Here's all the companies that went bankrupt, just a large number of them. Number of bankruptcies per year. You can see that they go in waves by state as well, which kind of probably highlights how marketing impacts this. So anyway, that's the asbestos side. So this brings up the whole topic of tort reform. Before I do that, I think I have at the very end somewhere. I don't know if y'all see this much anymore, but I still see these on. I don't have a TV, so I don't see much. But if I see a TV, I still see these ads. Have y'all noticed any of them? Mesothelioma. So they're still out there, And essentially they're saying, hey, if you've been diagnosed with this, it was probably caused by asbestos. We can probably file a lawsuit for you. What I think is interesting here is you see a little bit of the Judge Jack impact on this. If you or a loved one has mesothelioma, the disease is a result of being exposed to asbestos, you may have a right of recovery. Many of the responsible companies have set aside large funds to compensate, or their insurance companies have. If you have mesothelioma, that alone is not grounds for damages. In order to establish a claim, it must be established that you've been exposed. If you do not remember the name, we'll help you out. So, there's probably some impact from her requiring more evidence. So anyway, so what is tort reform? So tort reform was a huge issue about 20 years ago. It's something George W. Bush hit really as governor of Texas more than as president. Y'all were even alive when George Bush was president, were you? Or were you? Maybe you were not his father, right? His father was before your time. But George W. Bush. So Saturday Night Live had a field day with both of them, especially George W. Bush, and we pronounced certain words. A nice guy, but had kind of a Texas draw. So what does tort reform mean? So you'll see, I'm going to show you a few articles. You're going to see things repeated. So contingency fees for attorneys, I think, is one that's probably the touchiest, because you'll see places where the claimants are getting like $500, $400, and the lawyers are getting millions of dollars. You get a sense that the incentives are really, really distorted. Statutes of limitations, so you can't wait 20, 30 years to file claims. Limits on punitive damage, that's the one I'm not as comfortable with, because I do think there are times where massive organizations like a McDonald's do things that are pretty hideous, and telling them they can't get more than 2 times actual losses just doesn't seem like they're going to keep doing what they're doing, because that's such a small loss. This one's important to me, and that if someone's going to sue me, I don't want them to get my insurance plus my net worth. I want them to sue me for my net worth and my insurance coverages. So I don't want them to be able to combine those two together. And then limit the liabilities. So, the fact that Walmart happened to have some asbestos in a couple of buildings, you can't sue them for $1 billion just because they're still in business and still have money. You got to look at their actual negligence, how much they contributed. So those are some pretty common ones. What you'll notice here is this first article. Y'all don't need to read these articles. We'll cover it. But what you notice is the U.S. legislators in Congress was trying to enact tort reform, but they were really slow at it. So it went to the state level, and what you're going to see, the states actually did most of the work. So here's California. One thing you see added for California was annuities versus lump sum. If people can get a lump sum, they're much more likely to sue and push for it, because it's like the lottery. But if they can get $20,000 a year for the rest of their life, it's just not as much of an incentive. So malpractice was a big part of tort reform in the United States, because a lot of doctors were just quitting, and their premiums were hitting like 100,000. It's like, it doesn't really make sense to become a doctor anymore. It already is paying just to get the degree. So that was a big issue in California. Capping non-economic damages, that's the pain and suffering, and then those punitive damages. Mississippi requires plaintiffs to file malpractice suits in the county where the alleged injury occurred. So that's a huge one for class actions. Class actions, you're looking for the jurisdiction that has the best juries, the best judges, that you're most likely to get a claim. Now you have to break up that class action. You can only file where the actual injury happened. That would be a huge one to reduce claims. Medical liability insurers are also lowering insurable limits, and some are offering only claims made policies. So the medical malpractice side, essentially states are saying, hey, we don't have any baby doctors. We don't have any senior citizen doctors. We got to fix this. You can't force doctors to stay in the business. You can't force insurers to insure them. And so ultimately, if the trial lawyers win, ultimately comes the case where you disrupt markets and people, you can't build houses, you can't get health coverage. Southern Nevada has become the worst place in the country for women trying to find prenatal care. That's how bad. I don't think it's a problem today because most of these states have fixed it, but that was an issue there. Pennsylvania, West Virginia. So big deal. Texas, it was a big deal, and Texas got quite a bit passed at that time. So I remember those years, a lot of those debates. Every state was having very similar debates at the same time. Here's an article on asbestos specific to reform. 2 decades ago, analysts were predicting that litigation, which had cost about $1 billion, would run another $38 billion. It's already passed $54 billion. Now I think it's $210 billion. So you can see asbestos became this huge increase, but most of the claims were not coming from the people actually seriously injured. They're coming from these class action lawsuits. So suits for non-malignancies have jumped dramatically. Plaintiffs showed no evidence of injury. Asbestos defendants are very likely now paying compensation for every occupational disease known to man. Incipient or marginal asbestos, as picked up on X-ray, bears at least a superficial resemblance to other problems, but the potential of a huge payday impels a trial bar to find clients, irrespective of validities. Even some plaintiffs now recognize how they are being used. Last year, more than 2,500 litigants sued their lawyers. That makes the insurance industry happy, charging that the latter viewed their clients as mere inventory that could generate enormous legal fees. $2/3 of the dollars, this is pretty critical, 2/3 of the dollars paid went to those cases. If not most of the plaintiffs were not sick in any meaningful sense. Another problem is that the search for deep corporate pockets hits companies with no responsibility. These defendants now account for $6 and $10 spent on asbestos. So you can see why the claims have mushroomed so much. Strategies include insisting on proof of injury, ensuring reliability of medical evidence, and limiting punitive damages. So a big issue. So we've covered essentially the biggest issues that hit this industry the last 30 years. Some of them are current, like global warming and hurricane risk and those kind of things. Some of them are big problems that got fixed, and you're kind of waiting for the next one that's similar to hit next. You're starting to see that a little bit with the claims adjusters on the homeowner side and some of those debates, what's going on. All right. Let's go back to the class notes. I don't know what my issue is with highlighting. I don't even know what that is. If I get rid of that? Wow. All right, so we've been talking about commercial general liability. I think we got through here. We talked about a tort. We talked about, see, these are quotes from the article that we went through. Medical malpractice, we talked about that some here, just here looking at these articles. Asbestos, we've talked about that one. So I do have summaries of the articles in here. When you see the word ultimate in some of these articles, it's very, very similar to incurred. So ultimate just means what you ultimately expect to pay. So your ultimate minus what you pay today is your liability, which is the reserve. We're going to talk a lot about that when we get into the accounting. So incurred and ultimate really are almost simultaneous. Remember, Warren Buffett asked, should insurance companies be discounting reserves? And his argument was no, because he felt like insurance reserves are understated already. I don't agree with him on that. Some of these long tail lines like asbestos, if you didn't discount them, they would completely wipe out the company. Because if you got a claim that you're going to pay in 20 years and you got to put it in 20-year numbers, that's going to be a massive number. You've got to discount it back. So I don't quite agree with him on that. The insurance I dealt with, homeowners auto discounting doesn't have that big of an impact because they're very short tail lines. A couple years out, it doesn't have a big impact. But insurance like asbestos and medical malpractice, yeah, you almost have to. All right. I can't give you good topics to cover on the commercial side because that's not my field. I lost our commercial insurance guy. He was going to do something and then something came up. So maybe I'll get someone next year. We'll see. We do have the USAA guy speaking to us. I forget when you remember when I said he's coming? Let's see. Probably in April. April 6th. Kirby from USA. I think he's going to come here and be here and practice. And I was going to ask y'all, I have not asked the two UTSA alums at USAA that are actuaries if they would like to speak again. Do y'all want them to come speak? Not all of y'all are actuary majors. I mean, I can try. They might do it by Zoom. They were really willing to do it last time. And the guy, I can't remember his first name's a little unusual, but he's a heavy recruiter at USA, so he's not a bad person to know if you're interested in that field. So I'll try, see if I can get him. He's always said yes. She's just had a baby just a year or so. So she's like, I'm about to have a baby. I don't want to speak to your class. But she did speak last year. All right. There probably are some really good commercial insurance cases out there. All right, let's talk workers' comp. My main exposure to workers' comp is I was speaking at conferences all over the US for a few years there with the same two people, and the woman who was on the panel was a workers' comp person. So I was quizzing her constantly for feedback on what's going on. Workers' comp could be a really good paper 2 topic. It could just be something as easy as current issues in workers' comp, and things will come up. Rising medical, we'll talk about some of these. Rising medical costs, that's always been the case. Demographic shifts, mental health concerns, regulatory changes, obviously remote work from home. I mean, there's a lot of stuff going on with workers' comp. If you're interested in this topic, the Insurance Council of Texas has a workers' comp conference coming up. I could probably talk about Richard getting a person into that, maybe remotely, or at least talking to some of the people presenting there, as maybe they could send articles. So you might be good, you know, anytime you can find an excuse to increase your network, it's not a bad way to do it. Workers' comp does hire actuaries, a very specialized field. 6 trends, right there you have it right there. 6 trends shaping workers' comp. Labor shortages, eroding exclusive remedy, rapidly growing aging workforce, rising medical inflation. You see that all the time. It's not like it's not a new issue. They were saying rising medical costs back in the 80s on workers' comp. Catastrophe claim costs, that's interesting. I don't know what that would be. Expanding medical health claims. Mental health has been an issue for workers' comp. Can you blame the job for mental health issues, stress, long hours, those type of things? So yeah, here's 4 hot topics. Probably going to see the same things again. Aging workforce. Mental health, again. Exclusive remedy. So this one I think is really, really interesting because if it's a workers' comp claim, it should not be any other claim. So if you work for Xerox, which is a printing company, and you're using a Xerox printer and the printer blows up and injures you, that should be a workers' comp claim. You shouldn't be able to sue Xerox for a product defect. But you're noticing people are doubling up on this. Remember, well, we'll talk about workers' comp. It is strict liability. What strict liability means is it puts much, much more pressure on the employer to pay claims even when they're not negligent. But the offset of that is it limits what the employee can sue for. But that's what the exclusive remedy is employees are finding other ways to sue. And that's a big issue for workers' comp and workforce shortage. You're seeing the same issues over and over again, right? And I've just shown you right there, probably enough articles to do your paper on workers' comp, and then it'd be interesting to see what the ICT is doing. I forget when their conference is. I can look it up though. Even if it's already happened, you can look at the conference and just, do y'all do cold calls? I'm the shyest person in the world. When I started my career, I was scared to death. And that what that did is it made me really bold. It's kind of interesting because I was so scared to death. It's like I better do something. I'd read an article, and I don't even know how I did it because this is pre-internet. I'd read an article and then I would call the writer of the article. And I had the best conversations. This one guy, oh my word, he wrote an article in the Financial Analyst Journal. He was selling a product, so I had an excuse to call him because, I might buy his product. Unfortunately, his article shows you exactly how to do what he's recommending, so I could have built it myself in Excel, so I didn't need his, but still, it's possible I can buy it. Boy, he talked my ear off for over an hour. Poor guy got into debate in the Financial Analyst Journal with Ibbotson, and he got really beat up in that debate. And I called him after the debate, so he was kind of beat up. But I've done it. So sometimes, it's amazing, especially if you do the, I'm a college student thing, I'm a poor college student. Most people are pretty sympathetic to that and will talk to you, or I can get you in contact with Richard, and Richard can say, hey, yeah, I got a buddy over here, so-and-so, if you want to get into it. And so workers' comp would be a great way to do that because it's very specialized. The people who do that, this is all they do. They know it extremely well. And we give you a good chance. And you might actually get like a job interview. Isn't that kind of what you'd like? Says, hey, you have any jobs on the board too? I'd be really interested. I really love this field. So, think about that. So workers' comp, it's really hard to summarize all 50 states because they are very, very different. But there are some similarities. First of all is where we come from. It's not, a lot of people say we have workers' comp because of work. Work is much more dangerous today, but actually work is much less dangerous today. It was much more dangerous working on the family farm than it was working in a factory in the United States. But the thing is, if you break your leg on the family farm, your dad says, just walk it off, gonna get over it. No big deal. There just was no coverage. It's probably pretty tragic at times. So as we move from the agriculture age, where we had 96% people working in agriculture to, I don't know today what it is, but 2%, the workforce has changed. I remember reading Thomas Jefferson. Thomas Jefferson said, this is the end of the United States. His argument was, if we ever become a non-agricultural society, we're done for. I don't know if I could bring him back to life. He would still agree with that today. But we definitely have changed. It's pretty amazing, though, that we went from 96% agriculture and 2% agriculture and producing far more food today and are feeding the world far better today. It's pretty amazing, the technology there. But it has changed, and probably the agriculture here is probably safer than the agriculture there. So the industrial age increased the concerns about work safety, not so much because it's more dangerous, but mainly now because you had someone to sue, you had someone to blame. But early on, you couldn't. Early on, your rights as an employee were actually inferior to what rights of a stranger. So you're working in a company and some stranger comes in off the street and you both slip and fall and break a hip. Your company says, well, that was your fault. You were negligent. You should have been paying attention. And if you sue us, we're going to fire you. The stranger just sues the company, right? So the employer has some threats. They can say you can lose your job if you sue us. Or, you say, yeah, but I got 6 workers, my fellow workers, they're witnesses. They saw what happened. They say, yeah, we'll fire all of them if they testify for you. You don't have much power. So the law at that time was very much in favor of the employer. If the company could show that another worker was partially to blame or contributed, or if you're working in the mines, the coal mines, hey, it's a dangerous place. You knew it was a dangerous place when you started the job. You assumed the risk. That's where we're paying you all these big bucks. There's a great book out there. I got to find it and show it to you next class, but it's by the guy who wrote 1984. I get Orson Welles. Who wrote 1984? George Orwell. I get Orson Welles and George Orwell mixed up. George Orwell wrote a really, really good book about the coal mines. The reason I recommend you read it, kind of wait, but find a week in your future where you really hate your job and you want to quit, and then read this book, and you will not want to quit your job. So it's amazing how horrible coal mines were, how horribly the people were treated at working coal mines. But back then it was like, hey, we're paying you more because we can't get workers because it's so dangerous. That's your compensation for the risk. We're not going to pay you any more than that. Slowly that environment started changing. The employer was required by law. If you think about Roosevelt, Teddy Roosevelt, and what happened in the early 20th century. I know he's a Republican, but he's a Republican, pretty progressive Republican. The laws were changing, a lot more workplace laws and safety and those kind of things. A lot more was pushed onto the employer to make the workplace safer, to warn of unsafe conditions and make those conditions actually safer. Those employer defenses started getting chipped away. And unfortunately, somehow the US developed this legal liability culture where people were suing, and employers in the United States said, hey, we can't compete with the rest of the world. We're being sued so much, it's making the US, gives the US a huge disadvantage. So we got to find some compromise for this. And so that's what came up. The first state to do this was Wisconsin in 1911, Mississippi in 1948. So it took about half a century, third of a century to get everybody on board here. And what they came up with, and I don't know who, and this might be, if you did a paper on workers' comp, you might go back to 1911 and see who came up with this idea. Was there any anybody before this, 1800s, 1700s, any kind of idea of this strict liability applying to workers' comp? It's a pretty creative idea, but essentially what they said is, okay, we're going to make the employer liable whether or not they're negligent. Doesn't matter. You as an employee don't have to prove that your employer is negligent. If you're injured on the job, they're going to pay for your losses. Now that sounds like a huge loss to employers, but what the employer gets is that the employee agrees not to sue for anything over than general damages. All right, they can't get these massive, massive lawsuits. And even pain and suffering may not count because the states schedule the benefits. So if you break an arm, if you lose an arm, if you lose an eye or whatever, the state will say, hey, this is how much a leg is worth, this is how much an eye is worth. It's scheduled. So there's really as little, you see what they're trying to do is kick the lawyers out, make it very straightforward, reduce the cost because the legal side is, 40, 50% of the cost anyway. So that was the idea. That's why you see that exclusive right issue is such a big deal for workers' comp, because if you can sue for other reasons, it kind of changes this whole dynamic. They are administratively heavy. Most states probably have an entire department that just does workers' comp. And they have experts. If you work in this area, you're going to become a huge expert. If you're a workers' comp actuary, you're going to know the regulatory side extremely well because that's what you're pricing. So now the exclusive is starting to get challenged a little bit, where employees are allowed to sue even if they're injured on the job. Here's another issue. We didn't really get into it, but workers' comp was having serious issues in the 1980s. And it was completely revamped. A lot of that was related to that tort reform, is very similar type of issues. It's also related to managed care. What was happening, managed care, if you think about life insurance class, managed care came around in the 70s, and the managed care people so wanted managed care to be cheaper that they essentially were shifting all their costs to everybody else, including workers' comp. And so workers' comp was picking up all these costs. And what we discovered is managed care really wasn't saving costs. It was just trying to, smoke and mirrors, make it look like it was cheaper. A lot of that was fixed with a lot of reforms related to health insurance. Right. Workers' comp costs are a small percentage of employer spending overall, but it depends on the industry. Obviously, construction's going to have really high workers' comp costs. So at the time this data came out, the services side was seeing a huge increase in workers' comp. Any guesses on what injury they were seeing? Carpal tunnel, yeah, just took off. I didn't really notice it that much, but you started at first. This was at USAA, not to tell. I'm giving all my USA stories away. They're interviewing me for podcasts. And I'm like, can USA sue me for this? Because I'm giving some really bad stories on USAA. So here's another bad story on USAA. When these carpal tunnel came out, USA management was, oh, they're just faking it. It's really not that bad. And just like, shake it off. What's your deal? And then they started discovering these people were really seriously injured. Think about court reporters. Court reporters were just having it very seriously. So it's all the PC, all the typing we were doing. So everything changed at USAA. They started refiguring the desk and keyboards and all that kind of stuff. So what is workers' comp? How does it work? It covers everyone unless they're specifically excluded, and the state law is going to tell you what that is. Any business you go into, y'all probably seen them. They had the workers' comp sign on the wall. One business I went into and it said, do not have this facing forward. They had the wrong side up. You're supposed to have it turned around. I almost turned it around for them. But it gives information to the employees of what their rights are. Small businesses, fewer than X employees, are not required to. That's why you see in some states, small businesses stop right at 10 employees, so they don't have to do the extra. Here's really key. If you write a paper on workers' comp, the definition is so key. Workers' comp covers accidents arising out of and in the course of employment. That used to be easy. That meant you were sitting in the building. Now it's with remote work and people driving and all this, it's kind of lost that obvious definition. But arising out of and in the course of, this is where things like mental health issues have been an issue. What about a heart attack? Say, well, a heart attack, did the job cause it? Was it the stress? How do you prove it? What if a heart attack happened at home? Can you relate it back to the job? So this is huge. This is a big definition. Occupational disease, we talked about it. It can take years before you realize. So that gets back to exposure versus manifestation. It's really important in workers' comp, just like we saw with asbestos. What's not covered, although state by state might change it, someone's drunk at the time of the injury, intoxicated. Injuries incurred away from work, although that's changing now with remote work. I don't know if you get up and you trip over your dog, but you're working. I'm sure there's going to be some claims. I'll show you one of a person driving. Heart attacks on the job. I remember there's a gentleman who had a heart attack at USAA. He didn't die, but he did have a heart attack. Our workers' comp, Ton, I've talked about Ton before. She went into detail. How do we find out about it? Who showed up first? What do we do? How quickly did the ambulance get in? All of that stuff. That's her job, is to make sure, hey, are we doing, part of it is to make sure we're not going to get sued, but also part of it is, hey, we have this responsibility as a corporation to take care of our employees. Injuries during coffee breaks, that one, I'm sure there's been some tests on that. I don't know how you know exactly when that point starts. Driving to and from work, I think that's another one that's changing because of handheld or non-handheld devices. My boss had his cell phone glued to his ear. He was always on it. He was always driving. Didn't matter how dangerous it was. I made a mistake once where, I was talking on phone. I'm like this because it drove me crazy. And he's like walking down the aisle, and I'm trying to pretend like I wasn't exasperated with him, but he knew I was exasperated, so it didn't really matter. What happens if you have an accident while he's driving because of his cell phone use? You know, that's a huge issue, especially in Texas where supposedly that's illegal. But you can be distracted even with non-handheld with, you know, those phones are just as distractive. Horseplay between employees, I'm sure you could debate what exactly that means. So there are some things that are not covered, but again, you know, this is supposed to eliminate lawsuits, and yet you go down I-10, you see workers' comp lawyers advertising workers' comp claims. Obviously, people are suing, and a lot of it can be the debate of whether or not this is covered by workers' comp. The benefits, there is a morale hazard and a moral hazard here. The morale hazard is there are a lot of people who'd rather be home getting paid workers' comp than be on the job. The morale hazard is they may not be so incentivized to get better. The moral hazard is they fake a claim. So moral hazard is illegal. You can't fake a claim. Morale hazard, the fact that you're not working really hard to get back on the job, you know, that's not illegal. It will pay 70% of your pay, partly because the way the tax law works, but also part of the way is they don't want to incentivize people even more. You don't want to get 120% of pay because you're going on, or even 100% because you're going on workers' comp, and really incentivize people. There are people who hate their jobs that would, it's like, push me down the escalator, please. You know, it covers medical costs. So here's another product that covers medical costs. One of the first questions they'll ask you, your health insurance company are going to ask you is, were you at work when this happened? Because they want to get it over to workers' comp as they can. Covers disability. Right now, what you will notice, and we'll talk about this a little bit, is when you get your job, you may not be able to tell if you're on workers' comp or paid time off. You as an employee may not be able to tell which what's paying you, sick leave or workers' comp. FLMA doesn't pay you a salary, so that one's a little bit different, but workers' comp will cover your disability. That disability can be temporary or permanent. So temporary, obviously, they're waiting for you to rehabilitate and come back. There can be a waiting period. The waiting period doesn't mean you're not covered. What the waiting period means is your paid time off will cover. And then after 2 weeks, they discover it really is a legitimate workers' comp, and then workers' comp will go back and reimburse the paid time off. But you won't notice it. You're just getting a check. It just feels like all the same stuff. Permanent is you just can't go back to work for the rest of your lifetime. USAA, I worked in workers' comp for 1 week at USAA. Then my boss in my previous job, he wanted to go back, and so I went back and took his place, but I got 1 week. And I got to hear some really interesting conversations with the workers' comp people. Remember we talked about corporations buy insurance for the outsourcing? Workers' comp is the perfect example where the workers' comp people, they just know your employees, they know what's going on. They were a really good value added there. USAA had some carpal tunnel that were permanent disability. So how long does it cover them? Until they're 65 or for the rest of their life? Those are the kind of things that come up. And then other things that happen where the law just tells you what you're covered. There, you know, I don't know how different states handle it, but obviously a surgeon losing a hand is a lot different than an accountant losing a hand. You know, it's going to really radically change what they can do. Does cover death benefits, funeral costs, does provide some survivor income, and more rehabilitation benefits. If you can get the worker back to work, the better off. So it's worthwhile. I've only been to rehabilitation once. I found it completely useless, but I might have gotten just the wrong one. I separated my little finger on the first day of a hike into the jungle in Costa Rica, so it was dislocated the entire week. And I went to a hand doctor, and he had to reattach it, which was really painful. But he sent me to rehabilitation, and it was useless. And after 4 weeks there, I went back to the hand doctor, and he said, "Oh, just put a rubber band around it," and that worked perfectly. And it's like, yeah, that was a lot cheaper than the rehab. So I don't know how. I'm sure there's some really, really good ones, but that one was a waste of time. But insurance companies really are pushing rehabilitation. They can get the worker back. Part of it isn't just a rehabilitation, but it's the thought of the employee that I need to get back, I need to improve. So part of it's the psychology. Not every state has a private system. Some states have state-run monopolies. Some states have state-run monopolies and the private side. Some states allow self-insurance, especially if you're like a General Motors and you're big enough to have your own workers' comp company. So it can vary, but there are some good issues here. So what we'll do next class is we'll identify some issues you could read if you decide to do this as paper 2, some issues you could research because workers' comp has gotten really, really interesting, especially with remote work. So there's some topics there. All right, any questions on anything? Any questions on the exam? Everybody okay?
All right, let's start. Anybody else topics? I know Peyton, you gave me one. Put it down like that. And
We change mine to cybersecurity.
yeah, I was working. It's a good topic, but just can you find articles? All right, just make sure it's, insurance related, but there's a lot there. Others. What?
Cyber liability.
Oh, okay. Those talking about safety and insurance, let me show you this one. This one I think is somewhat interesting. So we talk about changing the cars that have an impact, but now they're talking about changing roads. When they changed 1604 in Bandera and the whole, I don't know if y'all drive down Bandera, but when they first started doing it, it's like, well, this is weird because it's like the people are on the wrong side of the road. They put this road in and then they put the lights up and it's like the lights are on the wrong side. It was really strange. Now they're doing that. This is an article I saw today.
North side, that's like nothing else in San Antonio, and as News 4's Joy Bergen explains, it should make the area a lot safer, so as long as drivers can navigate it. So we call the Diverging Diamond intersection, and it is the first of its kind for San Antonio. What that means is it's gonna take some getting used to, it's gonna cause some confusion, so that's why I wanted to take some time today to walk you through this new traffic.
So let's see what that term actually is, if it's a really defined term. Diverging diamond intersection in insurance. So so anytime we look at, anti-lock brakes, airbags, side impact, whatever, are they trying to reduce frequency? Are they trying to reduce severity? Are they trying to reduce both? Peyton's bring up the issue. Is it possible cars are safer but more expensive to repair? Is it possible they're reducing frequency but increasing severity, but the two together? So here is something, it's confusing. I think a lot of people on Bandera have gotten a little confused. And it's not just 1604 and Bandera. If you go further down Bandera, they're doing their best to do what we talked about in class, eliminate intersections. Just completely eliminate them as much as you can. Here's an article from TechStock. So it's an interesting concept. They don't do a good job in this video saying exactly how it reduces risk, but
Pattern. What makes this intersection so unique is that diamond shape where the north and southbound lanes of Blanco will briefly cross over each other. So that means you'll be driving on the left side of the road before crossing over again back to the right side. Now, the idea here is to minimize the number of traffic lights and to keep traffic moving as much as possible. Even though it looks a little bit scary, TechStop tells us it is actually both faster and safer. It's been implemented across the nation.
So faster and safer. I don't know on Bandera, it doesn't feel faster to me, but faster and safer. You end up on Bandera having to go further than you want to go and have to turn around and come back. Whether that's faster, who knows? But safer, I can kind of see safer, especially on Bandera because it really limits your ability to build up speed because of all those.
And which is by up to 60%, according to TechStop.
All right, that sounds like a frequency. 60% reduces crashes.
That said, applies on us knowing how to use it, right? So the key here is to really pay attention to your lane, especially when that crossover happens. Again, this is the first of its kind for San
That looks really confusing, doesn't it?
Antonio. The closest thing we've seen so far to this design is the intersection of Loop 1604 and Bandera. It's not exactly the same, but it has a similar crossover. And we have seen some confused drivers there from time to time, especially if they are new to driving through that area. That said, this intersection, not done just yet, but they are planning to implement this new traffic pattern sometime this month. And then it'll all be done by late summer, sometime this month.
So, yeah, it's, when y'all be driving this, Blanco, that's pretty far down. Y'all think y'all have to do this? It'd be interesting to see. Maybe try it out. She said it's the first in San Antonio, so it'd be interesting to see if you can find one outside of San Antonio and then see the impact. But is this the insurance industry driving this, or is somebody else? How much more does it cost to actually build the roads? You know, there's so many things in. How much faster is it? You hope our government is looking at cost from an entirety standpoint, not just the taxpayers' cost, but also our costs, waiting in traffic. You know, there's other costs out there besides just the direct costs of government. You hope they're looking at that. It looks like tech stock might be a good place to go on something like this. So we talked about the roundabouts. This is very different than the roundabouts, but probably similar type of context. They have a video as well. Easier, faster, and safer. I don't know what the easier means, but easier, faster, safer. They call it DDI, so it has its own, but I wonder do you think San Antonio is the first one in the state? Or not? In Austin, or really? Okay. Yeah, Austin needs anything, make things faster. It's some of the worst traffic in the state. So interesting. So there's places, you know, that are interesting concepts. And then you'd almost want to hear an actuary. How does it actually get into their pricing? How significant is it? So anyway, so I like that topic. Tyrone's going to be doing something similar to that. No, you're not. Who's going to do that? Andrew. So Andrew, there's a lot of places you can go with this topic. Not just the car itself, but actually the roads if you want to there. And you can see there's plenty of articles on this. This is really very well researched stuff. So you have plenty to work with on the articles. All right. Let's continue in our discussion on workers' comp. So if any of y'all want to do workers' comp, they're having their conference here pretty soon. So I could probably get with Richard and get you in contact with someone that could really, your paper could be an interview itself. If you could find someone, so you talk about networking, find someone, hey, what are the biggest issues in workers' comp? What's going on? Especially if you're an actuarial major, you know, finding an actuary in workers' comp, it's just an excuse. Hey, can I interview? It'd be a chance both to write a paper and to create a contact. There are a lot of issues in workers' comp. You saw when we looked up on the internet, you're seeing some related to healthcare costs, some related to mental health, some related to the exclusivity of workers' comp. You know, those are topics that you saw consistently throughout. So, and my list has some of those as well. Rising medical costs. A lot of workers' comp is essentially health insurance. There is disability as well, so it's health costs rising in the U.S. Are workers' comp healthcare costs different than the general public, or the different type of accidents, those kind of things? You know, it's you know, the biggest part of our healthcare costs is hospitals, and it's not pharmaceuticals, it's hospitals. That's the biggest rising part of the cost. So those things that put people in a hospital for a few days, that's going to be the highest cost. So is workers' comp that part of the healthcare system? So severely injured individuals are more likely to live due to better care. So what we're doing now is we're saving people and having them live longer, but they have chronic ailments, so the cost of that's going to be much higher. Whereas 50, 100 years ago, people just would not have survived. So our medical care is more expensive. It's also more effective. It also means it's going to be more expensive for a longer period of time. We're living longer. So people with these injuries are going to live to be 80 or 90 instead of 60 or 70. And so that's going to increase the cost. So the cost's not covered by fee schedules. You know, it really does depend on which part of the healthcare system you're hitting and where the costs are. We talked about life insurance class. Some of this is actually not a benefit to us. We're spending money on technology that really has no proof that it's making us healthier. So those costs are being spread out all over the place, including in workers' comp. So medical advances are improving the quality of life, but is increasing the cost to this program. Loss control is an important issue. It wasn't in the list I showed you on the internet. So I saw this at USAA, whereas the workers' comp and insurance industry walks into a company and doesn't just insure their workers, but shows the company how to get safer, what they can do to reduce losses. So that's what we talked about on exam one, those things you can do that actually benefit the company, benefit society, even could benefit the stockholders. So you use that loss control as a opportunity to reduce your insurance costs. You prove to the insurance company you are safer, fewer workers will be injured, and your insurance costs come down, and you're a better employee. Smaller companies may not work because they have so few accidents. Just being safer, it's unlikely to cut a claim, but a larger company would work. There is a political side to the rate setting process. Workers' comp is much more political than other insurance, and so it's possible experience could be improving, but you won't see rates come down. So, you know, not all of it will flow through directly. USAA, part of it was, you know, it's a hassle to have employees go out on workers' comp. You got to retrain a new worker. You got to deal with them. It's an administrative nightmare. If you can keep them from getting injured at all, it's even if the cost isn't that much different, it's just the hassle of having to deal with all of that. This is to me one of the biggest ones is that whole definition of arising out and in the course of it may be related. I should probably add the exclusivity of workers' comp might be related to that. That's the ideal behind workers' comp. If workers' comp covers it, nothing else does. But now with this, where we're mixing our personal lives and our work lives, it's like you can almost get reimbursed from both simultaneously. So what does arising out of and in the course of, and we saw in our list, mental illness is one that comes up. It's absolutely possible a job could cause mental illness. I was telling my risk management class about the stress of 2008 and being in finance. Yeah, I mean, it was our heart rates were much higher. Yeah, it was a tough time to be in that business. And that gets you to the heart ailments as well, mental illness, heart ailments. There's some jobs that are just much more stressful. Obviously, we talked about asbestos. An interesting case. I don't think this was a workers' comp. But flight attendants, I know y'all don't, you can't believe this, but you used to be able to smoke on an airplane. Can you imagine? You're in this box with 100 people and someone's smoking and you say, well, you can only smoke in the back. I mean, that makes no difference. So I've been on a plane. I don't like cigarette smoke. It really, really hurts my eyes. Not saying that people smoke are horrible people. It's just that it's really tough. I still remember at UT Austin, you couldn't smoke in an elevator, but you could smoke in the building. I still remember this one music student. He takes a puff on a cigarette. He sees a sign. So he puts out a cigarette, gets on the elevator, the doors close, and then he exhales. And we're all in there with all this smoke. And it's like, oh, thanks. I don't think you got the point of why you don't smoke on an elevator. And it was pretty hilarious at USA. They used to let people smoke in smoking break areas. And it was so hilarious because when you walk by them, it was just a fog. I mean, you had every smoker at USA in that building all in that one room, and those poor people all stuck in there with the cigarette. But now at USA, you can't smoke in the building, you can't smoke on the grounds, you can't smoke in your car driving on the grounds at USA. They've gotten so strict. So if any of y'all are smokers, I mean, it's kind of a good reason to stop smoking. It's just be really hard to do your job. We had a CFO of one of the subsidiaries who was a chain smoker, and he was constantly leaving his desk and having to get in his car and drive off campus to smoke and come back. It was just constant, the poor guy. So here's flight attendants. They're in this environment where you can smoke on a plane. Obviously, they're inhaling all of this. So they sued because they did see an increase in lung cancer in flight attendants. They sued, but did they sue the tobacco companies or did they sue workers' comp? My guess is they probably tried both. I think they ultimately, the lawsuit was against the cigarette companies, but it would be an interesting history to go back and look at. So yeah, and you really can't smoke. I don't think you can smoke. They don't even allow vaping on airplanes anymore, and it's a pretty serious crime to do it in the bathroom and try to manipulate it. But anyway, interesting history on smoking. Sometimes workers' comp isn't really justified, but the courts will allow the workers' comp claim just because the poor person who's been injured, the courts feel sorry for them and there's really no one else to pay. And so they take advantage and kind of assign workers' comp when it doesn't make sense. And then the changing role of work, where you could write an entire paper just on this. Work from home obviously is the most obvious one. Driving is a big part of work. I have this article here. See if it still works. So a distracted driver was awarded workers' compensation benefits for an accident that the claimant says was caused by her work-related cell phone. She's a nurse. She was on call. She's required to be reachable by pager. Y'all don't even know what a pager is. Do they still exist? People still have pagers. But that was kind of pre-cell phone. So she had to be aware. So if a page came in, a phone call came in, she had to at least look at it to see if it was work. So it was possible it wasn't work, but still, because of her work, she had to check. Because if her work didn't require it, she could have just let it keep buzzing and wait till she got somewhere else. But because her work required her to check, her work was really requiring her to be the distracted driver. The procedure for contacting the employee was the employee was contacted through pager. If she failed to respond within 15 minutes, she was paged a second time. She had been called on her personal cell phones. If she didn't respond, she'd be called on her home phone. So she had to keep her beeper and her cell phone with her. According to facts, at the time of the accident, she was driving home from work when her cell phone light caught her attention and caused her to glance down. Subsequently, she drove her car off the road in the gravel, wrecking her vehicle and injuring herself. She sought medical payment from her employer for the whiplash she suffered. She argued that if she hadn't glanced down, she wouldn't have gotten into the accident. The employer defended the claim, arguing that her accident did not arise out of her employment because she was driving home. So the Virginia, every state's a little different. So this definition could be an interesting paper too. How do different states define arising out of? If there is a causal connection between the claimant's injury and the conditions under which the employer requires the work to be performed, then it is rising out of employment. Obviously, there's could be a lot of debate and some subjectivity to that, which is probably why you have workers' comp going to court, even though they're supposed to avoid court. She used her cell phone for both personal and business related. She paid for the bill for her phone, and it was unsure whether the call was actually from her employer, but the court said, but they required her to pay attention to the phone. It's exactly what she was doing, so it didn't really matter. So ultimately deciding employer was liable and stated if it didn't matter who footed the bill for the cell phone, what mattered in the case was her duty to be attentive to the cell phone. Now you might argue that she would have still been attentive even if her employer required it because we're all distracted by our cell phones. So maybe there's a little dishonesty here where she's actually checking it because it might be from her son or her husband or whatever. But you know, she found a lawyer and she sued. Um, I don't even look at my phone at all. If I know I got a call coming in and if I hear it, I pull off the road, park where I can look at it. So I don't want any chance of that causing an accident. All right, so interesting case, worker related workers' comp. If you drive for work, you know, there can certainly be some issues there of you're required to be on the road, required to drive. Consultants go to other people's sites and work. So do they get workers' comp or do they sue the company if something happened at the company side? One thing you notice in those articles about big issues in workers' comp was older workers. And what you're seeing with older workers, many Americans are not ready for retirement. They just don't have enough saved up, but they can extend that retirement if they work 20 hours a week or 10 hours a week. And that's putting 65-year-olds, 7-year-olds at work. They have different type of injuries. I don't know if you know, I'm starting to notice it at 63 where, you know, it's just like I just fall over. It's like my word, I lost my balance. What is it like? Am I like 2 years old or something again? I don't understand it. And so I'm trying to work on my balance. I would think I'd run on a bike every day for 4 hours, so that would help my balance, but it doesn't help me just standing. And that's something that's just naturally as we age, we fall over more easily. The nature of the work itself, obviously keyboards um, and the other thing, in USA tried this, and I don't know if they're still doing it, but no assigned desk. I would find that really irritating, but you have a different desk. Any of y'all have that issue where you just show up and it's like whatever desk is available, you go work at it. You don't put your pictures of your family up at the desk. Well, the problem with that is different heights, different, you know, structures. What about COVID and pandemics? What's the the employer's responsibility for things that are picked up at work? As we get into autonomous vehicles, if they start having accidents and people are driving or riding in those, what's the liability there? And then gig employment. This is a huge issue. You see this in California. So are Uber drivers employees in California? So that was a big issue in 2025. Uber drivers in California are classified as independent contractors, not employees. What does that mean for workers' comp? And it's more than just Uber drivers. You know, you talk about DoorDash and some of these other things. So the gig, someone's doing the gig economy, right? I think. Yeah. So there's so much you can work with. So you could actually even bring in a workers' comp angle to this as well. So yeah, I mean, if you're not an employee, usually that means workers' comp doesn't count. This is also an issue with not just Uber, but our McDonald's workers, employees of McDonald's. You might say, well, of course they are, but what does McDonald's say? No, they're employees of whom? The franchise. Well, what if the franchise has 9 workers? So they're not required to have workers' comp. Can the employee get workers' comp from McDonald's? You know, so those type of issues. These are big issues. You're seeing this more in California than anywhere else, but it kind of California tends to bleed through to the rest of the country. So McDonald's employees are not considered employees, but rather of the individual franchises that operate the restaurants. So that can be an issue. So the gig economy is just going to keep getting bigger and bigger and bigger. We're going to have more and more independent work. I think AI, you know, I should probably put this in here. AI by itself, you just throw AI in everything, right? A friend of mine sent me an article on AI, just freaky, scary kind of stuff. I'm glad I'm 63. If I were you guys, I would be doing at least one AI request a day and really pushing it pretty hard to see what you can get out of it. I'd be trying Claude, I'd be trying Chat GPT, I'd be trying DeepMind, DeepSeek. I'd be doing every single one of them. Are any of y'all paying the $20 a month? I would start spending money, and so I would be really getting into it. I use AI to write my macros now because I've become a dinosaur in macros. And AI is better at writing micros than I was anyways, so it kind of saves me time. It's pretty amazing. We use AI to do our podcast. I'm kind of tempted now to let AI write our blog as well. We write a blog and then AI converts it into a podcast. It does an amazing job. Sometimes it gets it absolutely wrong. Last week it got it really wrong. So I had to cut out like 5 minutes, but it does it pretty amazingly well. But what does that mean for workers' comp? And sometimes you can just say AI and workers' comp and something will come up of AI and workers' compensation. So it could be AI helping them with the claims and helping them understand what risks there are and those kind of things, or it could be AI itself is actually causing some new type of risk. I don't know what it would be. Here they say, am I using AI to ask about AI and workers' comp? The integration of AI and workers' comp claims management. So they're talking about on the management side is reshaping the industry. You're probably going to see that in almost every business, auto insurance, homeowners insurance, AI. So how to reduce workers' comp claims with AI, it's more on the business operations side and not on the asset claim side. So AI is something you can always bring in almost every discussion. The next one is fraud. I won't show you the videos. I don't think I have some, I might show you a little bit. They're kind of, to me, they're depressing to watch. But so the Coalition Against Insurance Fraud, obviously they've got a bias, so they're probably exaggerating their numbers. We're saying tens of billions of dollars in false claims and unpaid premiums are stolen in the US every year. Where does the fraud come from? The most common forms of workers' comp fraud is remote injuries. So a worker gets injured away from work, but they try to make it look like they get injured at the job. So maybe they broke their leg playing football, and they get their buddies to take them up to USAA and throw me down the escalator. I can blame USAA. USAA, sometimes you have to wonder if the firm's really thinking through this. USAA puts signs on the escalators like warning high-speed escalator. What are you trying to do there? Were you trying to reduce frequency? But what are you also doing? My guess is you're increasing severity because someone gets injured, you can say they knew it was a dangerous escalator. They even put a sign up saying it. I remember one of the restaurants, I went over, I told one of the workers, this floor is just so slick, you could not work on it. It was really dangerous. Thinking they'd go over and dry the floor. Instead, they put a sign up warning slippery floor. Well, again, they're just telling you, we know it's dangerous. But here we got a worker who is injured away from work, come to work, they look around the building, what can I find in this building that could have caused this particular injury, and say I was injured here. That would be illegal, it would be fraud, and could be a felony. Inflating the injuries, you have a minor injury at work, but then you exaggerate it, make it look bigger. Faking an injury, obviously, pretending like you're injured out. One of these videos does that. You have an old injury and you try to get workers' comp for that. The other one is you don't want to go back, so you pretend like you're still injured. I think in The Office, wasn't it? They're trying to get Oscar. Was it Oscar? I get them all mixed up. The accountant, right? That what's his name? Rainn Wilson, whatever he is. He was trying to get Oscar on workers' comp fraud, pretending like you're injured when you really are recovered. Sometimes abuse, and this might be where this particular agency is exaggerating numbers, is they say it's abuse, but it's just the doctors asked for additional tests that they generally would not be allowed to have asked for, but then they find something, you can't really call that abuse. I'm not gonna, I'll click through these. I just want to give you a quick kind of idea. I actually find some of these disturbing, so I click through them even faster. Yeah, this one's kind of the worst one. All right, so this guy is perfectly fine, but he's pretending he got injured, and he's pretending like it gave him the mentality of a 6-year-old. And he now has act like that for the rest of his life. Which is kind of tough to do, right? Because you got to go outside. So he's pretending now. I find this painful to watch. So someone to go through this trouble. I won't make you watch all of that. But then you can never stop doing that.
It was normal adult life. He even kept playing golf, which is where the cops arrested him for insurance fraud.
So as soon as he gets out of the car, guess what he starts doing? So then he gets back into the act immediately. This is a problem with insurance fraud because you got to leave your house, and your employer, if they're suspecting, they hire detectives go out and watch you. So he must have really, really hated his job. This guy, a little bit more extreme, kind of crazy.
After successful hand surgery to correct a workplace injury, Steve Spencer was put on temporary total disability. Keyword being temporary. But Steve apparently decided that he liked not working for a living and devised a clever way to extend the length of his stay on the disabled list. Right before his visit to the doctor, Steve would strike his formerly injured hand over and over. The hits would irritate the hand, giving it the appearance of being inflamed. He would do this in his driveway and in traffic on the way to the doctor's office. Unfortunately for Steve, his insurance company didn't trust his lingering injury, and they videotaped his trips to the doctor. Soon after, Steve was arrested for fraud. He got 2 years probation and had to pay for the detective who caught him. Talk about adding insult.
All right, what about a serious back injury?
Scamming for workman's comp insurance.
Here's someone with a serious back injury. Does that look serious to you?
Yeah, great idea, if it works. But when it doesn't, well, that's when you'll catch people in some of the most unbelievable lies you'll ever hear. Like people who are so hurt they can't work, but they can go bowling. That's what happened to this game. He filed a claim for an injured left knee that
Left knee, sorry.
prevented him from doing his job. Well, an undercover camera busted him on the lanes, bowling a couple of pretty nice frames, judging by his reaction.
So you'll see these. You can't always be sure this is workers' comp specifically, but sometimes they're workers' comp, sometimes they're disability insurance, and sometimes they're social security disability. They're all the same. They're all illegal. They're all felonies. That one guy got probation, but he had to pay some of the costs back. Some of them can be actually jail time. It's pretty serious, so it's not something you would want to do. I can't remember what this one is, but maybe there's a couple of them in here, but Bill Gates, you can do it. Just shows you some people really, really hate their jobs. If you go through that much trouble. This one's workers' comp specifically.
And some companies say enough is enough here. Tonight, we will take you inside one company that is fighting back and seeing results. Does this guy look like he suffers with a bad back?
So that's the bad back guy. Problem with fraud is you can't live your life normally because you got to keep pretending.
Sure. He makes several trips up the ramp, at one point lugging a refrigerator. Julio Racinos apparently wants you to think his back is so bad he can't work at all.
He's claiming just recently he cannot bend, stoop, squat, lift anything heavy.
I'm gonna say all that right there. Until a year ago, Julio worked it.
Yes.
Someone
So
being suspected.
I don't know what he got, but
The bill. Call the Insurance Fraud Hotline, toll free, the number you see on the screen there, area code.
Extra goes after suspected workers' comp cheats. Want to see if we can get a quick word with it. An undercover camera records a firefighter frolicking in the throat. Arrest him in a pond spot. And yet another hidden camera captures a golfer on the tee, never realizing he's being watched. But why are these weekend athletes under surveillance?
Let's see if any one of these is interesting.
They cannot work because of on-the-job injuries.
Yeah,
And
if you want to watch, I mean, there's plenty of them. You can just actually go to YouTube and just do workers' comp fraud, disability insurance fraud. There's plenty of examples out there, unfortunately. And they're these thousands and thousands of dollars. I mean, it's more than one cost. There's a cost that they're paying these people salary. They also have to replace the person at work. I got to train the person. They got to hire detectives to go out and monitor them, all this kind of stuff going on. It's pretty expensive for companies. And so they are fighting back. I don't know what USA did in these terms. Like I didn't work in workers' comp long enough to see if they had a fraud prevention. I'm sure they do. USA had a few hundred, I guess, or dozen. It would not have been radically overwhelming for them to monitor these employees. There wasn't so many they couldn't have someone go out and check on them. So it's not like they had tens of thousands of them. The employers can be fraudulent as well. By one thing you do with workers' comp is you send the insurance company a list of all your employees and their salaries, because that's what you're replacing. But if you understate that, they're going to charge you a lower premium. So you got to be honest on what you're actually paying your employees. I don't know if I told y'all this story. It was amazing at USAA. I was doing the employee life insurance, which we needed salaries, and someone sent me the file. I said, I need a file. I was assuming they were going to send me a file of the total salaries, but they sent me a file with every employee's name and their salary with the CEO at the very top. And I looked at it, clicked off of it, and emailed them. I was like, you should not be emailing this out. Can you imagine? Boy, they could have gotten a lot of trouble. I didn't even look. I saw the CEO's name, but I didn't look over. Y'all, I know y'all don't believe me, but I did not look at his salary. I didn't want to know it. Would have depressed me too much. So you have to report payroll correctly. You can say, you're changing insurers and you say, oh, our last experience is really good. We've had very few work-related accidents. So you lie to the insurance company. Or you're required to have workers' comp and you don't purchase it. So those are issues. Fraud is always an issue anytime you're replacing someone's salary. So workers' comp, disability, or Social Security is always an issue. USA used to have a disability. I don't know if they're still doing disability on their life insurance company side. Very employee heavy, a lot of work. You just have to have a lot more employees. It's a much more difficult business to run just from a personnel standpoint. Claims admin, more and more companies are outsourcing. So they're not really buying insurance. Instead they're hiring insurance companies to handle a lot of this administrative work. The problem with that is if you separate the workers' comp from the employer and you send it to some third party, it may make the employee less likely to come back. You really need to act quickly to try to get the employee thinking that they're coming back to work. So you may have a few months there. If you do it internally, you may have to hire an actuary. USA had 2 actuaries I know of that were not part of the insurance business. They had one actuary for the pension plan. They had one actuary for the health insurance side. I don't think they had an actuary for the disability and workers' comp side, but you might have to hire an actuary internally. That's an expensive employee. But your goal is to get the employee back to the job as soon as possible so that they don't have an incentive. They get too much of the habit of staying away. You're seeing a little bit of that with remote work, where employees are having a tough time coming back to the office. They're just so used to being away. This next one I wish we would cover. You've already heard me complain about this, but workers' comp is predominantly health insurance. We also have health insurance. You also have health insurance in your auto insurance. Why can't we just bring all these together in one program? Well, in some countries that is true. They don't make a distinction between health insurance and workers' comp. It's just all part of the same program. That's really hard to do in the United States because workers' comp, it is an employee benefit. It's managed by the federal government, whereas insurance is regulated by the state. So ERISA mandates what workers' comp's got to do, but the states monitor and manage and regulate the insurance companies. there's really very difficult to get those two groups to work together closely. And so it's tough in the United States. You as an employee, you don't really care. If it's paid time off, workers' comp, your health insurance plan, maybe there's a difference in deductibles and those kind of things, especially on disability income, you really don't care if it's workers' comp or your company's disability program, you just want to be paid a salary. But it's hard to harmonize those because you have different regulators, but that would be great. And so what most employers have done is they're managing them as two programs, but they're trying to make it look like one program to the employee. So the employee doesn't feel like they're getting shifted back and forth. And then a lot of firms are focusing on a very structured return to work program where they incentivize their employees and their insurance companies. Let's work in a way that we get this employee back. So my 1 week at USAA in workers' comp, we sat down with the insurance company of the big stack of claims and just went through each person. How is so-and-so doing? What's the last report you had on them? Or are they getting better? You know, so yeah, you have that kind of detailed thing of how can we get these employees back into the business. Cyber risk, does that relate? I don't think so, but you'll see a lot of articles asking about cybersecurity and workers' comp. I don't think they came up with anything. I don't know, Antonio, you might find something, and Sophia find something related to workers' comp and cyber risk. I don't think you're going to find that, but it's possible. And in workplace well-being, organizations are trying to figure out how do their employees feel. How are they doing? That could have an impact on workers' comp. Happier employees tend not to go out on workers' comp. You do surveys and those kind of things to try to figure out how they're doing. That can certainly have an impact on workers' comp. Those are the issues. None of y'all want to do a workers' comp paper? I would find it fascinating. It's not my field of study, but I would find it fascinating. I've never had a workers' comp claim, so I can't talk from that standpoint. All right. So we're going to really shift gears. Talk about pricing. When you see the problem, you're going to find it amazing that I'm going to ask actually this on the exam, but probably 20% of students get the question right. 80% miss something, but I give so much partial credit. You can get 90% and get the completely wrong answer if you can go through the process. We'll talk about the process. So pricing is really important in insurance. This is where the actuaries get involved. I got involved in the pricing from the investment side, so I gave them the investment side. So bring this down a little bit, and that's as far as I can go. So what is a premium? It's really straightforward. It's just a discounted cash flow. Discounted cash flow of what? Of claims, expenses, and profit. So the premium is the present value of the claims where you're using the discount rate. It's going to be what you think you're going to get on the investment side. That's that float we're talking about. You get premiums today, you invest it. It was interesting to me. We got a new CEO, Bob Davis. He came from the banking side. He had no insurance background. He was adamant that the investment returns did not belong to the property and casualty company, that those belong to the corporation. And I pointed out to him, the CFO of the P&C company was in there, a good friend of mine. And I was thinking she might say something, but there's a new CEO. And I was like, fire me, what do I care? So I said, yeah, sorry, Bob, but state regulations require you to give the investment returns in your pricing back to the customer. And he was mad. He slammed his fist. And he asked the CFO, is that true? He goes, yeah, unfortunately, that's true. I want to make sure he saw that, because he was about to make this thing that the actuaries are not allowed to include investment in their pricing. And it's like, that would be illegal. You have to take that in consideration. That has not always been the case, but in the 70s, when interest rates got so high, states started saying, you've got to take that float, that delay in time, you've got to take that and pass that back to the customer. You can't just keep charging them higher premiums. So as interest rates rise, premiums should fall because you can invest. Now, the offset of that might be inflation, maybe insurance, maybe claims are going up because inflation's higher. So you're getting higher return on your investments, but you're paying out more. So those two might offset each other. But this is the what they call the underwriting cycle, or forget the exact word now for some reason slipped my mind, but the correlation between insurance price premiums and interest rates. There's a negative correlation. Interest rates are higher, premiums tend to be lower. When interest rates are low, premium rates tend to be higher because of that cost of float, or that float investment return. There are short tail lines and there are long tail lines. So the short tail lines, the investment return doesn't have as big of an impact, but it certainly has an impact. Longer tail lines, much, much more important. And then you add to that what we call loading. And that's the present value of your expenses, both LAE and underwriting. And you have to throw in some profit. So my job on the pricing side, which I loved because I got to work with actuaries, I always enjoy working with the actuaries. My job was to give them the investment return and to give them our cost of capital. And I use the capital asset pricing model to do that. USAA doesn't have a beta because it's not publicly traded, but I went out and found insurance companies similar to USAA, like Allstate, and got their beta, and you applied that to USAA, and it worked well. There was no regulator that questioned capital asset pricing model. They all accepted it. It was well received. They did question my assumptions. How did you come up with this or that? You could argue that USA's beta should have been lower than the competitors because USA is much more highly capitalized, but I didn't have to do that. They didn't question it. So if Allstate's beta is 1.1, I used 1.1 for USAA to get the return on capital. And then the actuaries did all of the forecasting of future claims, forecasting of expenses, and all of that. And so it just kind of all worked together. I did that for a couple of years. It was pretty fun. I enjoyed kind of working with them. It was interesting to me when I met with the actuaries. They knew the capital asset pricing model as well as I did. In fact, I think the only reason they want to meet with me was to see if they could stump me, because they were like, yeah, we know this better than the investment people. But I kind of held my own, but they were definitely very knowledgeable. So here comes this float thing again. And the cost of float and all of that comes back into these equations. The interesting thing about insurance is we don't know our cost of goods sold up front. We don't know until the future. And you saw that with Warren Buffett with 2001, with the 9/11. You don't really know what you're going to pay out in claims until the year is up. On homeowner side, you're looking at catastrophes and hurricanes and earthquakes and those kind of things that can radically change. At USAA, every July, August, September, we were watching hurricanes closely because if we could get by without a major catastrophe, our bonuses could be 50%, 100% higher. And we were like, oh man, please don't hit, please don't hit. There's a big difference between a $50,000 bonus and a $100,000 bonus. We're sitting there watching it, so we're like, please turn left. Auto physical damage, that's the actual damage to the car, is about as short tail line as you can get. Because if you're in an accident, you're probably not going to wait a year or 2 years to have your car fixed. You're probably going to have it fixed pretty rapidly. Homeowners is short tail line, except for a catastrophe, because it can take a long time to rebuild that many houses. And asbestos is maybe one of the longest tail lines. And so that's going to affect not just your claims, it's also going to affect your expenses. You're doing the present value of your expenses, that's going to be spread out over many more years as well. And we already talked about return on capital. CAPM is just accepted everywhere. It's probably the easiest way to come up with that. I won't go back in here, but if you don't remember Miller Modigliani in your finance major, and I bet an actuary as well, they probably have some of this on the investment exam on the actuaries. Miller Modigliani, capital mix, optimal capital mix. I won't get into it, but you should know it really well. You should be able to write a paper on it off the top of your head. It is one of those really classic ones. I don't know if either one of them is a Nobel Prize winner, because I think at least one of them passed away before they could win the prize. But it is if they had been alive long enough, they would have both gotten Nobel Prize in economics on this. It was that important of a discovery. And so you should be able to, if you see this chart, you should be able to explain it off the top of your head without any notes. So that's that important. It's kind of like CAPM, right? You should be able to explain CAPM off the top of your head, Miller-Modigliani off the top of your head. Y'all probably had this in, well, I cover it in 3013, but you probably had it in corporate finance as well. So you probably have had it in a couple of classes. Pretty important concept. So what is the cost of capital? The WACC, the cost of capital of a firm. You have your weighted debt times the cost of debt. Most insurance companies or many insurance companies do not have much debt because they're essentially borrowing from the policyholder. So that kind of changes this equation somewhat. USAA did calculate its cost of debt, including insurance reserves. So you can include it in context. You do adjust it for taxes. The only reason cost of capital comes down as you add more debt, that's what this is showing. As you add more debt, more of your cost of capital is being shielded by the tax code. And so your cost of capital comes up. At some point, you have so much debt that you start jeopardizing the survivability of the firm, and your cost of debt goes up and your cost of capital goes up. As you add more debt, your cost of equity goes up. All of that is true for insurance companies. It works the same way. You make those adjustments. I probably should have put USA's cost of capital lower than Allstate's, but the regulators didn't question me, but I should have used Miller-Modigliani in my analysis. Cost of debt is always going to be lower than the cost of equity because the debt holders get paid first before the equity holders. The cost of equity, you already know, the capital asset pricing model. So all of this that we've learned applies to insurance companies equally, and you use it for pricing. I never saw this on the life insurance side because the regulators are like, they don't care what you charge on the life insurance side. But on the property casualty side, you'll see this all the time. And the other thing you'll see unique to banks and insurance companies is this word capital. For firms outside of banks and insurance companies, capital usually means debt and equity, but when you see it applied to a bank or insurance company, they really just mean net worth, just the equity of the firm. And what's unique about the capital of insurance companies and banks is they have to hold capital related to the financial risks that they're taking. So if you do really risky business like homeowners, you're going to have to hold more net worth than if you do auto insurance. So the more risky you are, the higher your cost of capital and the more equity you have to hold. So you get this double whammy. You have to hold more net worth, and the cost of that net worth is going to be higher. So that's why homeowners insurance is such a horrible business. You have to hold more equity, and your return on equity has to be higher. It's a very, very unprofitable business when you adjust it for the cost of capital. All right. What is the beta for an insurance company? So we already talked about beta, right? Beta is measuring the systematic risk of the company. I would argue the liability side of an insurance company is generally uncorrelated to the overall stock market. It's possible we could have such a large hurricane or earthquake that it would drive the stock market down. You did see that in Japan when they had their earthquake. The Japanese earthquake did cause the Japanese stock market to drop, but it didn't last very long. But generally, that was a big event, you know, a huge tsunami. But generally, the liability side, especially talking about auto insurance claims and those type of things, generally the liability side is pretty uncorrelated. But the asset side of an insurance company is highly correlated to the markets because they're just holding stocks and bonds. So that implies a high beta. So the liability side implies a low beta. The asset side implies a high beta. Most insurance companies are going to have a beta around 1. I know you're not supposed to look up beta on Yahoo Finance, but I'll do it here anyway. In the past, when I've looked up Allstate, their beta has been pretty close to 1, maybe 1.1. I haven't looked at it in a while, but we'll see. Oh my word! See, that's no way that's correct. You can get these wild betas where they drop dramatically. There's no way you would use a 0.21 for Allstate. I mean, this can happen. I remember Ford Motor Company should have a really high beta, right? Because they're extremely cyclical and have a lot of debt. I've seen them bet their beta on Yahoo Finance at 0.65. It's like, I still remember a student came to me, they were doing this discretionary retail product that should have had a beta like 1.3, 1.4. They were about to do a presentation as a team and they were using a beta of like negative 0.7 or something. It's like, wait a minute, your beta, there's no way your beta is correct. And I told them, ignore the beta in Yahoo Finance. And so that's what they did. They ignored it. They used a more practical one. That became part of the presentation. They got a high score just because they did that. It's like, well, y'all should give me some of your points then. But yeah, what is Yahoo Finance doing? You can see it right there. They're using monthly stock data for Allstate and monthly stock data for the S&P 500, and you're just taking the slope. If those of you that have, well, none of y'all had my other classes. Any of y'all done my rolling betas? My class, Miles has, so you remember how just volatile that can be. I should do that for Allstate and show it to y'all next week. Allstate should have a beta of about 1.1, kind of a little above 1, but not materially above 1. So the 0.21 just means nothing. This could be because they're not a tech company, and tech stocks have been driving markets. They've been the main force behind it. Same thing happened in 2008. If you were a bank, your beta was 2.5 or 3. If you weren't a bank, you were Walmart, your beta was like almost nothing. I've seen Walmart's beta go negative, which doesn't make a lot of sense either. Um, let's see if that's just Allstate. We can look at Chubb as well. Oops. Come on. Chubb, CB, I should have known that. Yes, insurance company betas look really low right now, and this is probably because they're not the thing being talked about in the market. Progressive. Yeah, ridiculous. I'm gonna have to bring these in. I've got a spreadsheet that calculates the betas for multiple companies all at once. So I'll bring in some of these companies and show it to y'all. Y'all can see how volatile it is. These are probably kind of all-time lows on their betas. Doesn't make sense at all. Berkshire Hathaway is predominantly insurance, but they do a lot of other things as well. Still way too low. So yeah. And it's probably because tech firms, no, that one's not all that high. Software companies, so that's part of the problem with using historical betas, is they're really sensitive to the particular time period you're looking at. And so back in 2000, we had a dot-com crash. Technology stock betas were really high. During the financial services crash, financial services company betas are really high. So it's just the nature of what we've been through the last 5 years. I don't know if energy companies are showing higher betas because, or maybe even negative betas, because when oil prices rise, the stock market's falling. Exxon's got a 0.35. Exxon should have a beta below 1. We tend to buy gasoline no matter what's going on, but not 0.35. Now, what does this imply? If I'm showing a bunch of firms with low betas, what does that mean? What's the beta of the stock market? 1. So if a bunch of companies have low betas, what does that have to mean? Got to be a bunch of companies with high betas. And so who are those companies? And so you'd have to figure out who those are. And I can't do enough companies to figure that out right now. But generally thinking this industry is the beta, if the beta of the market's 1, insurance companies are slightly above 1. The required return reflects the systematic risk of the company, not the total risk. There is sensitivity to inflation, to commodity prices, right? Because you're building houses, you're fixing cars with aluminum and metal. So there are those type of things. Those are the ones that do maybe argue some relationship to the overall economy, even on the liability side. But this is not a radically high risk industry. The required equity that you need. So that was the cost of equity. How much should insurance companies be making? for their stockholders. And then how much equity should they be holding? Regulators are not looking at systematic risk, they're looking at the total risk of the company. So they're not using CAPM. They're saying given, because they don't want a company to go insolvent under their watch. So they're going to look at the total risk. If you have a lot of homeowners insurance, you need to hold a lot more net worth than if you're doing auto insurance. If you have an asbestos exposure, you're going to have a whole lot more net worth. We'll talk a little bit more about risk-based capital, but risk-based capital is what the regulators use. They break up risk into 4 groups: C1, C2, C3, C4. C1 is the risk coming from your investments, your assets, your stocks and bonds. That one's very well defined. I don't know what the deal is with the property and casualty actuaries, but the life actuaries did all the work on this. And the P&C actuaries said, oh, that looks good, we'll just do that. So, and that's mainly because the life side is much more investment focused than the P&C side, so they had a whole lot more work. I did keep their work. I think I still have it at home. It's a thick package where the life actuaries justified all these numbers, and it looks like something written by life actuaries. It's like, how can we make this more complicated? It's like, yeah, we can put some formulas in, no one knows. So yeah, it's a pretty tough read. C2 risk is the insurance side. The insurance side is on the property casualty side, really thinking about catastrophes. How could losses come in much higher than would be expected? And how much net worth do you need to set aside for that? That's where that PML comes in. We already talked about PML. It's hard to implement a PML requirement for all companies from the regulator standpoint. They've talked about it, but regulators don't have catastrophe models and they don't feel comfortable relying on the company to do that, but they have talked some about doing that. They're probably not holding enough net worth on the property and casualty side to cover catastrophe risks. So USAA ignores the regulators entirely, and they use their own CAP models, and they decide. Really, USA is much more focused on rating agencies than they are on the regulatory side. But deciding, and this is where USA holds most of its net worth, especially for property and casualty on the homeowner side, catastrophes. That's probably 80% of their net worth is held just for that homeowner's product. C3 doesn't apply to the property and casualty side much. It really applies to the life insurance side. That's the interest rate risk. The risk that interest rates shoot up or shoot down. That's really a big deal for the life insurance side. And then other regulators on what they discovered of these 4 risks, which ones causes the most insolvencies? And it was other. It was bad management. It was fraudulent management. And I found a new article, I think, out there. I can't remember. But it was an interesting article on the fraudulent side. But companies coming into Florida and doing homeowners and intentionally undercharging and just rolling the dice, there won't be any major hurricanes. And they pick up all this business, and then once they get all the business, then they jack up their prices. And there are some of these firms that have done this multiple times in multiple states. They're just hoping, put a little bit of net worth into it, undercharge, get all this business, go out of business. If you don't go out of business, you're lucky Florida doesn't have a major hurricane for 5 years. You've got a business that's going to make money. And if not, you go insolvent, you shut it down, and you move over to Louisiana, and then you move over to Alabama, and you just keep doing that. That falls under other. It really is just a firm that's just poorly managed. How do you handle that? The regulator said, well, we don't know how to measure that, but we know when that happens, the rest of the industry has to bail out these companies. So we're just going to put something in there that State Farm, you're going to have to bail out another company. We're going to put something in your C4 risk for you having to bail out these other companies. It's just something they threw in there to have something to add to it. Rating agencies do something very similar, probably more sophisticated models. The problem I had with rating agency formulas is there was no correlation between their capital requirements and the ratings they actually gave the companies. And you would think a firm that had a really good capital ratio, so they had a lot of net worth versus their risk, would have a high credit rating. It didn't work. What I found that I had to do was stratify the industry by company size. Rating agencies tend to give higher ratings to big companies and lower ratings to small companies. If you stratified it, there was a high correlation between how much net worth the firm had versus their risk and their rating. Big companies with extra capital got higher ratings than big companies with lower capital. So you had to break it up. Size of the company seemed to be more important than how they did on the capital formula. And that was the frustration at USAA because we had a subsidiary that's kind of small and they had a lot of net worth. And it's like, why aren't we AAA rated? And then I had to tell them because you're just not big enough. Unless you get to be 10 times your current size, you're not going to be AAA rated no matter how good your capital is. And it was kind of frustrating to them, but at least let them know, give up on it. We're not going to waste any more time on this. Yeah, so homeowners has a very high requirement for capital. Auto has a very low requirement. I've seen a very fraudulent company. I won't mention its name. It's more on the life insurance side, but it used to go around bragging about how much net worth it had versus its competitors, but it was selling the most risky product. And so they were quoting S&P to say they had more capital than their competitors, but they weren't quoting their capital formula from S&P that showed they were really weak. And they were presenting their company to my brother, and I was like biting my tongue. It was like, man, you guys are lying through your teeth. It was pretty bad. So you can't just look at their net worth versus their assets. You have to look at their net worth versus the liabilities, the product mix, what they're actually selling, and how risky that business is. So the bottom line is your return on capital. You need to make your cost of capital. If the regulators don't let you do that, you're probably going to shut the business down. That's what Warren Buffett was saying. What word did he use? Blithely walk away, or sanguine? Was that the sanguine or the blithely? I can't remember. Blithely means you walk away happily, right? Or was that sanguine? I think sanguine means you don't care. So yeah, if you can't get your cost of capital because the competition is charging too little, you say, hey, you know what? If we need to make 12%, we're going to make 12%. If we can't make 12%, we can only make 10. We're not going to do this business. So that return on capital is extremely important. Most businesses set their target based on a gross margin target, but insurance, it really is return on capital. In fact, that's true of banking as well. These are return on capital businesses. That's why when you're looking at valuations, for tech companies, you're probably going to look at price to earnings or enterprise value to EBITDA. For retail companies, you're probably going to look at enterprise value to sales. But for insurance and banks, you look at price to book value, because they're return on capital companies. Price to book is just really, really critical. And you'll find most of them trade pretty close to book value. Which company is that? That's Exxon. Look at MetLife. Watch them be the one that doesn't apply. They're a little rich, but not that rich. They're trading at 1.79 times their book value. Their stock value is 79% higher than their GAAP book value, but pretty close. Because if I do this for Palantir, what is Palantir? How do you spell Palantir? A-N. I can't remember if it's E-N or A-N. What do you think their price to book is? But it's not 1.79. It's 64. So insurance companies and banks, they trade pretty closely. I can even put Citibank in there. Citibank trades really right at its book value, 105. So price to book is what you look at here for these firms. They trade pretty close to their book values because the reserves are set up are pretty accurate. The actuaries do a pretty good job. And then their assets are marked to market. So you've got a firm that really should trade at book value. So we're looking at return on capital because that capital number is a pretty good number, and return on capital is going to reflect, the capital reflects the risk of the firm. The riskier the firm is, the more capital you need, and then the return on capital is going to reflect the risk of the firm. The more risky the firm is, the higher the return needs to be. If you want to really see this, if you use Bloomberg, a good way to understand this, you use the WACC function in Bloomberg. They give you some detail on the cost of capital for all firms. It's a really good function, very interesting. All right, so next class, I really want you between now and next class have decided on your topic. If you can't figure one out, give me a call in the next couple of days in the morning and I'll find one. you want to find one where you can find a good article. You might start with finding the articles and then picking the topic. So the Institute of Highway Safety, there's all these places, those catastrophe model firms like AIR and RMS. There's plenty of places you can go to find some good articles. So we'll start here. Bring your calculator next class. You will be shocked at this formula. It's not as easy as my life insurance class, but I do give a lot of partial credit, so it won't be a disaster. All right, I'll stop it there.